Hey there. Money can be exciting, but it comes with risks. Whether you're running a business, investing, or just managing your finances, understanding financial risks is key to staying ahead. Today, we're diving into the 6 main types of financial risks with real-world examples and practical tips to manage them. Let's get started. First up, operational risk. Operational risk comes from internal processes, systems, or people failing. Basically, when things go wrong because of how a business runs. It's not about market swings or external events, but about slip-ups like tech glitches, human errors, or even fraud within the organization. For example, imagine you run a small online store. Your website crashes during a big sale because of a server issue, and you lose a day's worth of orders. Or maybe an employee accidentally sends sensitive customer data to the wrong person, leading to a privacy breach. That's operational risk in action. Now let's talk about how to manage it. 1. Strong systems and processes. Invest in reliable tech, like secure servers or updated software, to avoid breakdowns. Regular maintenance is key. 2. Training. Make sure your team knows what they're doing. Regular training can prevent errors. 3. Checks and balances. Use audits and internal controls to catch mistakes or fraud early. For example, have 2 people review financial transactions. 4. Backup plans. Create contingency plans, like backup servers or disaster recovery protocols, to keep things running if something fails. 5. Insurance. Get insurance for things like cyber attacks or equipment failure to cover potential losses. Next, credit risk. Credit risk is the chance that a person, company, or even a government won't pay back money they owe you. It's a big deal for banks, lenders, or even businesses that sell on credit. For example, let's say you own a hardware store and sell $10,000 worth of supplies to a contractor on credit, expecting payment in 30 days. If the contractor goes bankrupt and can't pay, you're out that money. That's credit risk. Now let's talk about how to manage it. 1. Check creditworthiness. Before extending credit, research the borrower. Check their credit score, financial history, or references. 2. Set limits. Don't lend too much to one customer. Spread your risk by diversifying who you give credit to. 3. Clear terms. Use written contracts with clear payment terms and penalties for late payments. 4. Monitor payments. Keep an eye on who owes you money and follow up promptly if payments are late. 5. Insurance or factoring. Consider credit insurance to protect against defaults, or use factoring, that is selling your invoices to a third party to get cash up front. Now, let's discuss market risk. Market risk is about losses caused by changes in market conditions, like stock prices, interest rates, or commodity prices. It affects investments and businesses tied to fluctuating markets. For example, suppose you invest $5,000 in a tech company's stock. If the stock market crashes or the tech sector takes a hit, your investment could drop to $3,000. That's market risk hitting your portfolio. Now let's find out how to manage it. First, diversify investments. Don't put all your money in one stock or sector. Spread it across stocks, bonds, real estate, or other assets to reduce the impact of a single market drop. Second, hedging. Use financial tools like options or futures to offset potential losses. For example, if you own stocks, you could buy a put option to sell them at a set price if the market falls. Third, stay informed. Keep up with market trends and economic news to anticipate changes. Fourth, long-term focus. If you're investing, think long-term to ride out short-term market dips. Fifth, limit exposure. Avoid overinvesting in volatile markets if you can't afford the risk. Next, we have liquidity risk. Liquidity risk is when you can't access cash quickly enough to meet your needs, either because your assets are hard to sell or you don't have enough cash on hand. It's about having money when you need it. For example, you own a rental property worth $200,000, but you need $10,000 to cover an emergency expense. If you can't sell the property quickly or don't want to sell it at a loss, you're stuck. That's liquidity risk. Let's discuss how to manage it. 1. Keep cash reserves. Always have some cash or easily accessible funds, like a savings account, for emergencies. 2. Diversify assets. Hold some assets that are easy to sell, like stocks or bonds, rather than just illiquid ones like real estate. 3. Line of credit. Set up a line of credit with a bank to borrow money quickly if needed. 4. Cash flow planning. Forecast your cash needs and make sure you have enough coming in to cover expenses. 5. Avoid overleveraging. Don't tie up too much money in long-term investments if you might need cash soon. Next, we have legal risk. Legal risk arises from legal or regulatory issues, like lawsuits, fines, or changes in laws that impact your business or investments. It's about the law catching you off guard. For example, imagine you run a small cafe and a customer sues you for slipping on a wet floor, claiming you didn't put up a warning sign. The lawsuit costs you legal fees and a settlement, even if you win. That's legal risk. Let's discuss how to manage legal risks. At first, stay compliant. Know the laws and regulations for your industry, e.g., health codes for a cafe, and follow them. Second, contracts. Use clear, lawyer-reviewed contracts for business deals to avoid disputes. Third, insurance. Get liability insurance to cover potential lawsuits or legal claims. Fourth, legal advice. Consult a lawyer before making big decisions, like signing a lease or launching a new product. Fifth, risk assessments. Regularly review your operations to spot potential legal issues, like safety hazards or unclear advertising claims. Finally, we have foreign exchange risk or currency risk. Foreign exchange risk happens when currency value changes affect your business or investments. If you deal with international transactions, a shift in exchange rates can cost you money. For instance, you're a US-based importer buying $50,000 worth of goods from Europe, priced in euros. When you sign the deal, €1 equals $1.10, so you expect to pay $55,000. But if the euro strengthens to $1.20 by the time you pay, the cost jumps to $60,000. That's currency risk. Let's see how to manage it. 1. Hedging. Use financial tools like forward contracts to lock in exchange rates for future payments. 2. Local currency transactions. Whenever possible, negotiate deals in your home currency to avoid exchange rate fluctuations. 3. Diversify suppliers. Work with suppliers in different countries to spread the risk of currency swings. 4. Monitor exchange rates. Keep an eye on currency trends and time your payments to take advantage of favorable rates. And 5. Currency accounts. Hold accounts in foreign currencies to avoid constant conversions. And there you have it, the 6 types of financial risks. From operational hiccups to currency swings, they're all manageable with a little planning. Diversify, stay informed, and always have a backup plan. Got questions or want more tips? Drop a comment below, and don't forget to like and subscribe for more money smarts. See you next time.